afternoon, everyone. On behalf of Amref, I would very much like to welcome you all to this session on blended finance for universal health coverage. Of course, there are many challenges when it comes to improving the quality of health services, to increase access, efficiency of health services, and to increase the affordability and financial sustainability of healthcare delivery. Innovative approaches, new financial models are needed if we want to achieve UHC by 2030. Since a couple of years, Amref is venturing into innovative initiatives and aims to develop bankable solutions for better health in Africa based on shared value partnerships. We are very happy with the session that we are having today and hope we can spark an interactive discussion about opportunities and challenges in blended finance for UHC. John, from here, I would like to hand it over to you to kickstart this meeting and introduce our wonderful panel. And I wish everyone a very inspiring session.
Thank you very much, Danny, and thanks to Amref for organizing this session. For those who want to make sure they're in the right session, this is a session on blended finance and universal healthcare coverage. As Danny said, we have an all-star panel. We're going to start with Martin Edlund, who is the chair of the Health Finance Coalition and the CEO of Malaria No More. Then we'll go to Maxwell Antwi, who is the director of the Medical Credit Fund and the country director for Farm Access in Ghana. Then we will go to David Higgins and Kanini Mutuni. Kanini is the CEO, managing director of the Draper Richards Kaplan Foundation, and David Higgins is the impact investing lead for the Johnson & Johnson Ventures. And then we will close up with Rushika Singhal and Femke Boss. Rushika is vice president for global health at Medtronic and leads Medtronic Labs, which she can describe a bit more in her presentation. And Femke Boss is a fund manager at FMO, covering, among other areas, the health sector. We will kick off with Martin with a discussion on what is blended finance and a specific example that has recently been implemented. If we go to the next slide, why don't I give a quick overview of how blended finance works, and then I'll leave it to Martin to talk about a particular case and approach that the Health Finance Coalition is using. But basically, blended finance uses concessional capital, the sort of capital in the blue box, to open the aperture of funding for more private capital. We're all aware that in many instances where you can have a tremendous amount of impact, there is still several obstacles to overcome to put private capital, private investment, either debt or equity, into those opportunities. But if you can use concessional capital, which can come from many sources, it can come from public institutions, aid agencies, development finance institutions, and philanthropic funders. If you can use concessional capital to either reduce the risk or increase the opportunity for returns, then private capital can take advantage of this opportunity to earn even a modest return, not necessarily a very high return, but a return that meets its minimum criteria and still scale a tremendous amount of impact. And so to talk about a particular approach and example, let me turn it over to Martin. Martin?
Thanks, John. Thanks, Denny, and our hosts at Amref. Great to be with all of you. So my job is to set the scene, to talk a little bit about the challenges and opportunities in blended finance. And the way I'm going to do that is talk about the journey we've been on with the Health Finance Coalition. So if we go to the next slide, really want to start with the challenge. Why is blended finance, as John described it, needed to achieve health goals in Africa? And as everyone at this conference knows, Africa faces a massive health financing gap, a gap between its ambitions and its resources to accomplish those goals. And you see some of the numbers here on the left side. So Africa has 16% of the global population, 23% of the global disease burden, yet only 1% of global health spending is in Africa. Even when you look within the money spent in quote unquote impact investing, here on the right side, only 1.6% of that is going to the health sector in Africa. And so what that sets up is a yawning gap. The WHO estimates about 240 billion in annual additional spending required to achieve Sustainable Development Goal 3 and the goal of universal health coverage. And so this becomes a make or break moment for the SDGs. It's worth remembering that it was about 5 years into the Millennium Development Goals when we saw the major new donor financing come online in the form of PEPFAR, the Global Fund, the President's Malaria Initiative. And so that sets up the question for us, where is that money going to come from this time? And of course, COVID is only exacerbating the problem. Donor countries have spent over $14 trillion on domestic stimulus packages. So we're not going to see that step change in donor financing at this moment. Meanwhile, African governments face a perfect storm of challenges: falling revenues, an additional $100 to $200 billion in mounting health costs, and about $100 billion in debt payments over the next few years. So it's not being melodramatic at all to say that the SDGs could become the unsustainable development goals if we can't close this financing gap. Next slide, please. So this sets up the need for blended finance. It's our belief that to achieve UHC and Africa's health goals, we need a new approach, one that positions private capital to co-invest with countries and major donors to serve the populations with the greatest need. We call that taking a capital stack approach, and here you see it represented on the right side, with private return-seeking capital investing alongside public sector capital. So just over a year ago, we created the Health Finance Coalition to demonstrate this thesis and show a path to scale for blended finance. It was convened by Ray Chambers, who comes from the world of high finance and now serves as Dr. Tedros's WHO Ambassador for Global Strategy and Health Financing. We brought together a great group of partners to work the problem: technical agencies like the WHO, multilaterals like the Global Fund and the World Bank, leading philanthropies like the Gates Foundation, Rockefeller, and Skoll, and private industry players like Philips. And you'll all be comforted to know that John Simon, our host, is also a part of this effort with us. And so we set out a year ago to accomplish two goals. Number one, to do demonstration deals on the theory that nothing creates momentum like concrete action. And secondly, to put in place a strategy and structure for an investment vehicle to source, construct, and transact blended finance deals at scale. And to demonstrate that you can invest in the core areas that matter most to health outcomes, like supply chain and care delivery. Next slide, please. So the reality, as we all recognize, is that these sources aren't actually a stack. They're at best a jumble. You have, if you look at this continuum from vulnerable populations on the left to mass populations in the center to high income populations on the right, you have capital playing in different parts of that. And so our opportunity on the next slide to achieve the greatest impact is to bring these various pieces together into closer coordination and really to target that middle and mass segment that's private capital is not currently investing in. Next slide, please. So the question becomes, what are the barriers to blended finance? Particularly, what are the barriers to blended finance at the scale of the problem, at the scale that we need to be working? So the first challenge, as we saw it, was deal flow. If you think about private capital and how it typically operates in Africa, most funds are in what we would call seek mode. They're looking for shovel-ready deals with strong unit economics that are de-risked, that are kind of ready to go and investable. It's our contention that if you want to have the greatest impact, you need to be in what we call construction mode. You need to be in the mode of identifying problems, the right models where you've seen a real proof of concept, and then bringing together the operators, the investors, and importantly, government engagement to make them investable, scalable, and sustainable. And it's hard work and requires specialized capacity and skill to do that. The second thing you need is to right-size return expectations. You can't serve the bottom of the pyramid if you're also looking for venture capital-like returns. So you need to create realistic risk-adjusted returns that are going to prioritize impact and serve populations of the greatest need. And finally, you need to do the hard work of actually coordinating investment between private capital and the major donor institutions and countries. And this dialogue just isn't happening in the way that it needs to for us to reach the scale we need to achieve. Next slide, please. Now, if you can do this, it opens up a range of really interesting opportunities. Investments in private enterprise, but not just in city centers and capitals catering to high-end populations, but bringing the efficiency, the innovation, the impact of private enterprise to peri-urban and rural areas. Secondly, it opens up the opportunity to make sustainable and scalable some of the exciting public-private partnerships that we're seeing and that organizations like Amref and its partners are leading. And then lastly, we need to be focused on connecting the dots between national health insurance schemes, data, mobile money, digital wallets, and make sure that people have the resources to make these new models work. Next slide, please. So you'll hear a little bit more about this from Maxwell, one of our partners. But I said our first goal was to do a demonstration deal on the theory that nothing creates momentum like concrete examples. And so it was about this time last year that we put together a pipeline of prospective deals. And as happened to all of us in some form or fashion, we of course realized that COVID was here to stay and was quickly spanning the world. And so there was actually a moment where we said, do we need to go pencils down and wait for the world to normalize? And of course we decided, no, if blended finance has a meaningful role to play, it has to contribute in a meaningful way to the COVID challenge and the pandemic. And so one of the first challenges that we identified is the risks to private health providers on the front lines in sub-Saharan Africa. As many of you know, private health providers provide something around 50% of essential care for things like malaria, maternal and child health. And so at a moment when they saw their revenues disrupted by 40-50% or more, they needed working capital to keep the doors open, to provide PPE, to do some small scale construction to protect people as they came in for those core services and came in with possible COVID conditions. And so in the best of environments, it's hard for these frontline private hospitals and clinic and pharmacy networks to get capital. Impossible in the context of COVID. And so to solve this challenge, we put together a $35 million loan guarantee facility. So about 20 million in guarantees from great partners led by the U.S. Development Finance Corporation, plus some private philanthropies, Skoll, Rockefeller, and Ray Chambers' MCJ Amelia Foundation. We brought in USAID and the President's Malaria Initiative to strengthen training around differential diagnosis of fever and to work with these clinics. And then our lending partner was the Medical Credit Fund, who of course has a fantastic network of borrowers across the continent. And with this loan guarantee, what we're able to do is support 1,600 clinics serving over 5 million people. To maintain their essential services in the face of COVID and its aftermath. And as you see here, this is not elite audiences in city centers. 56% of beneficiaries are low income or very low income, many of them women and children. So it really speaks to maintaining that core capacity and brings together market rate lending from the Medical Credit Fund, private enterprise in the form of these 1,600 frontline private clinics and pharmacies, and then some of the more concessional capital players like the U.S. Development Finance Corporation and private philanthropies together in a capital stack model to address one of the most timely and urgent challenges in the face of COVID. So we have a great panel and lots of people to contribute. Let me stop there and hand back to John.
Thank you very much, Martin. And I'd also note that there's a chat space where people can put into their questions. The next question actually is the latest question. The one question that came in there actually relates to health insurance, which I think is one of the things that our next speaker can speak to, Dr. Maxwell Anthony. Three questions I have. First, the Medical Credit Fund was created as a blended finance approach. Can you describe a little bit how that approach has allowed you to accomplish what the Medical Credit Fund has accomplished? More than 100 million in loans to date since its inception. How has COVID affected your capability, and how has the open doors guarantee mechanism, African private health initiative, ADAFI, helped you combat the challenges from COVID? And then lastly, you may want to spend a few moments, given how much work PharmAccess has done in the insurance space, on how this work on the supply side links to the demand side in terms of creating a framework in which people can access medical insurance as on the way to UHC. Maxwell?
Oh, John, thank you. I think we'll make it very, very brief, touching on the three important questions. I think Martin has explained the rationale and the barriers to blended finance, for which one of the instruments that has been used to demonstrate that blended finance can be a real opportunity to increase access to health SMEs financing has been quite demonstrated. But let me just mention that MCF was among the first to enter the blended finance space. Over the past decade, a medical credit fund has pioneered, I think, a novel model of blended finance to support private health SMEs across Africa with quite impressive results. If you look at, John, what you just mentioned, I think that medical credit fund provides a strong, case study, let me put it that way, showing that a blended finance approach, especially when combined with hands-on technical support to help SMEs grow on the clinical side, but also on the business side, and to improve on the quality of care that they give, can actually open up access to finance for the health SMEs. As you rightly mentioned, the results of the medical credit fund blended finance approach are there for all to see. I mean, nearly about 2,000 health SMEs have been reached with nearly 6,000 loans worth over 100 million USD. And the critical thing is that over 80% of the health SMEs improve on the clinical quality score. I think that MCF has shown that blended financing is a viable approach to reach health SMEs and other SMEs. I mean, if you apply generically, that otherwise are unreached by traditional financing model. So I think it positions it well in the blended financing approach. We were not expecting COVID in Africa for a while until somewhere in the first quarter of last year when COVID arrived on the shores of Africa. One of the critical ripple effect of it was that financing to the health SMEs especially grounded almost to a halt. And this is because the banks, there were lockdowns, there were shutdowns, nations were operationally incapacitated, and financial institutions were highly compromised. So in addition to not getting access to finance, one of the key realizations that we had was that the operational cost of the health SMEs were also elevated. And that's because they had to put in all these preventive measures, and they had to put in all these protocols. And these things cost money. They have to train their staff on infection prevention again, and put in other equipment and consumables. And these take capital out of one's working capital. The third blow to the health SMEs that we realized was that patient numbers dropped. So actually in Ghana, at the heat of the pandemic, patient numbers dropped to about 30% of the pre-COVID levels. So you have the health SMEs being hit by these three blows. First is that they developed the financing that they initially were used to, which was the banks were no longer available. Secondly, operational costs had gone up. And thirdly, income and revenues had reduced because patient attendance had nosedived. So that's why I think what Martin mentioned, which is the Open Doors Africa Private Health Care Initiative, comes in very handy. And if you see that Martin shared initially, it's quite impressive. I mean, to use, and I think we'll have more opportunity to talk about it, but to use 19 million as a guarantee to unlock 35 million so that health SMEs can have access to emergency loans and 1,600 SMEs reached through the Medical Credit Fund. I think it speaks to the value that blended finance, whether in the midst of a pandemic or when we are in a stable state, can be a huge instrument for opening up access to the health SMEs. I think I would end here.
Thanks, Maxwell. And like I said, we'll circle back for some of these questions as we go along. And please, everyone, feel free to put more questions into the box. We just got another one. So speaking about sort of investing in ventures in the African health space, David, you are the impact investing head for J&J Ventures. How do you look at investing? Do you look at it from a concessional or purely commercial point of view? And where do you see blended finance coming in to help support the types of investing that J&J does?
Thank you, John, and nice to get an opportunity to be on this panel and to contribute on behalf of J&J and the work that we do. And maybe perhaps just to kind of give some perspective on where J&J fits within this sort of space. I mean, our legacy has primarily been as a grant provider, but I think we obviously recognize that there was a growing need for innovative and impact-focused finance initiatives. So back in 2016, the J&J Foundation began exploring impact investment, looking both at sort of, for social impact and financial return, so that kind of double bottom line challenge. So now, over the last few years, we've been piloting various health subsectors and impact investment models with a view to kind of create a balanced portfolio for where our reach, expertise, and capabilities and such like grow and succeed. Our work started with an initial allocation of $15 million, which we've used to make 7 investments to date. Our average ticket size usually is of the order of $500 to $1.5 million. And back in November of 2019, we launched Johnson & Johnson Impact Ventures. And that was part of a new impact investing initiative under the Johnson & Johnson Foundation dedicated to scale and impact and access. I think to date, as I mentioned, we've had 7 investments. They have traditionally been direct investments. Blended finance is something now that we are in the context of running a pilot fund, identifying and recognizing there's a need to kind of broaden the scope for our work. And why are we attracted to that? I think blended finance, I think, provides a number of interesting new opportunities and can do things in a different way to kind of direct investment. I think it clearly provides, if you look at it from the macro sense, provides increased funding for development outcomes, so the public capital can be redeployed to other programs. And also, I think the presence of private capital in these developed blended finance structures can also drive the sustainability of the fund kind of longer term. The attraction from our perspective from blended finance is really around the ability to de-risk investments in high impact sectors, and I think the possibility also for us to enter into new sectors or business models. I mean, in terms of the opportunities that opens up, I mean, there are a number of interesting areas that are on our horizon and that we've been looking at. We feel that the ecosystem to support investment, for example, in for-profit solutions to address primary care challenges in much of East Africa and certainly in Kenya exists and is evolving. But primary care is universally recognized as a key component of universal health care. But there are significant challenges and a significant funding gap in the provision of primary care in public facilities. And it's very, very difficult to attract traditional impact investment into that sort of space. There are obviously significant challenges around the provision of those public primary care and those sort of models around poor infrastructure, lack of budget, lack of expertise in this sort of sector. But I mean, there are a few examples, I think, of successful PPPs at primary care, but we believe this is an area that holds an awful lot of opportunity for the future, and one that excites us in terms of the possibilities. And we also see that, particularly in Kenya, the Ministry of Health really now has an appetite to drive universal healthcare, and is likely to be supportive of this sort of space. So that's something that's very much on our radar right now.
Thanks, David. One of the questions actually was about the role of government, so we can explore that a bit more. And the second thing, I think you very articulately described the opportunity at the primary care level, at the bottom of the pyramid, which is very much something that the Health Finance Coalition, which of course has one of its members, Philips, another major corporate in the global health, who also see very much the same challenges and opportunities that you see. So that's also an area I'd like to explore in more depth when we have the time for the open discussion. But moving on to Kanini, Kanini Draper Richards Kaplan is one of the premier foundations focusing on social entrepreneurs and investors and enterprises at the sort of early stage area. You are also about, I believe, to either launch or have launched an impact fund. How do you see the small enterprise fitting into the journey towards universal healthcare, and where does blended finance potentially come in to help make that connection?
Sure, John, thanks a lot for this opportunity. And just to clarify as well, I'll be making my remarks wearing the chair hat, because I also sit on the board of Amref Health Innovations, which is Amref's health social enterprise arm. So I'll sort of just take liberty and move between those two roles. So, I think just to give a bit of background in terms of who we are as DRK, we are venture philanthropists. And what that means is that we're taking all the rigor that you find in the venture capital world and sort of transplanting it into the social enterprise space. So the basic premise of the way we work is we are not looking for above market returns, we're looking at below market returns. Our primary focus is social impact, and what is completely secondary to us is financial return. So we're quite lucky in that sense. We are actually on our fourth fund, John. So we've raised 4 funds. We're on fund 4. We've closed it at $80 million. And our focus has always been early stage ventures who are trying to solve the biggest problems in the world. And when you look at the health space, we've come in with a focus on Africa, and that's part of where I'm building my portfolio within the organization. And not just the healthcare space in general, we're very excited about what e-health has to offer, because we think that when you put together the fact that mobile phone penetration in Africa is 75%, and also the fact that there's such a high number of underserved populations in the continent, it just makes sense to use e-health as a way to scale and to give Africans access to health. So just to give you an example, our most recent investment was in an early stage company called Baobab Circle. And I just want to talk a little bit about our approach there, just to be as specific as possible. And Baobab focuses on providing treatment and care for NCDs, non-communicable diseases. In fact, NCDs have been referred to as the silent pandemic. So I think that should resonate with most of us around this table. And our approach to Baobab was that we brought in our concessional capital at the same time capital stack that included grant capital from folks like DFID or FCDO. So I think the beauty of that is our capital was coming in, was a convertible debt, and then FCDO brought in their grant capital with a very specific purpose for Baobab to expand into 3 other countries in the African continent. And what we liked about that was a mix of capital with a focus on supporting Baobab to scale and to scale at impact. And to be honest, John, I think there's not enough transactions of this type. Unfortunately, lots of impact investors are coming into this space with, in my view, overly high expectations of return that in my mind just cannot be achieved in this particular sector over the short term. So we are in it for the long run. Our capital is patient capital. And at the ultimate end, what we're trying to do is, within the medium term, attract commercial capital to come into these companies and organizations. But in the meantime, we're not just deploying, sort of spraying and praying. What we're doing is working really hard with the social enterprise to help them organizationally build up their boards, build up their business models, and then help them access commercial capital later on. And, to the question that was raised earlier around governments, this is something that DRK really values and Baobab also brought to the table. So they partnered with 3 African ministries of health in order to scale their platform. And for us, that's completely key to scaling any kind of healthcare enterprise. It's got to be strong partnerships with government. And these 3 governments provided Baobab with access to NCD patients, provided them with potential access to national insurance. That's another question that's been asked in the chat. And, at the end of the day, a private enterprise does need government, and it's close to impossible to do this on their own. So, for us as DRK, we're sort of walking away and sort of looking for other enterprises of this type where you can combine government capital, government resources, private capital, and help an organization scale and grow and really make an impact in the healthcare space.
Thank you very much, Kadidi. And that is a great example of blended finance, and also a great example of the opportunity for blended finance to create the chance for high impact enterprises to scale. And in scaling, obviously, you have to figure out how you interact with the larger healthcare system, which I think is critical connection that has to happen as part of this effort. You mentioned non-communicable diseases, and that's a focus, obviously, of Medtronic and Medtronic Labs. So let me turn to Rashika now, and she can describe a little bit of what Medtronic Labs has been doing in this space and what they've been trying to do on the finance side, including in terms of creating programs that interact with the broader healthcare system and really take on major NCD challenges in terms of case management. And by the way, we're getting a lot of questions now, finally coming through the Q&A, so I'll try and group them in a little bit and make sure they get parceled out to the appropriate folks. And also, Danny put in a Jamboard link. If people just want to comment on the Jamboard link, they can do that as well. I'll try and keep an eye on that. Rashika?
Awesome. Thank you, John. Good morning, good afternoon, good evening, everyone. So maybe talking a little bit about NCD and what we do at Medtronic Labs. I think in the spirit of, as a leading private sector player in the medical devices space, we've been going through an internal journey as well, trying to figure out how do we leverage our scale, resources, and capabilities to address the healthcare challenges that the world is facing, and especially in underserved communities. So, traditionally very much grant focused through our philanthropy arm. We've been experimenting with the idea of creating social business and really looking at, again, that double bottom line, David, that you were talking about in terms of how do you build sustainable models, but truly focus on impact. So our approach has been, we actually created a standalone entity called Medtronic Labs, where our goal is not to make profit, but to truly focus on developing business models and technologies focused on reaching underserved communities. So we've got a few projects primarily in India and Africa at the moment. And the projects with NCDs, John, that you're referring to, we call that Empower Health. And it's essentially a full service delivery model that enables physicians and facilities to remotely manage patients living with hypertension and diabetes and really support that longitudinal care. Like, I think we all understand on this session that this is not a one-time intervention. This requires behavioral interventions and just ongoing support. And beyond the initial screening, patients often fall off sort of their treatment paradigm. So, our approach has been, how do we partner with folks? So, we've actually partnered with some of the the diagnostics devices, as well as with the intervention, in this case, primarily being pharma intervention. So we have a very close partnership with Novartis, where we designed this whole model and said, all right, how do we deploy this in the existing healthcare system? So we've partnered with the Ministry of Health in Kenya, as well as some of the county governments, and have been deploying this entire end-to-end model, which includes not just the digital tools, but the service delivery model, including training of all of the healthcare facilities, people, community health workers, and then providing patient support through telecounselors and nutrition counselors and things like that. So we've deployed that in 3 counties across Kenya, and we're managing about 18,000 patients right now there, and growing rapidly through now that we're coming out of this COVID phase. And as we look at that, the sustainability questions and impact at scale really starts to come in the sense that from the Medtronic side, we're leveraging a lot of our sort of philanthropic capital and investment capital to do this with not necessarily a high rate of return, but then we can do this ourselves. Novartis can do this themselves, even though they have the access portfolio. So then how do we come together with the public sector to scale this work? And I think this is where some of the blended finance thing becomes really interesting, because you need concessional capital to get things like this going. You need to then bring in private capital to do this at a bigger scale, 10x, 100x. And then there has to be sustainability, which is where truly the end game comes in for the government, where assuming that we're able to provide care, we show outcomes, which is the great thing with the new technology tools that we have at our disposal, that monitoring and evaluation and showing improvements for patients has become a lot easier. Then the savings from those outcomes then get captured, that eventually will enable governments to pay for it. So we also look at this as, how do you look at outcomes as and results as like the trigger for payments, and we believe in that, so that there is sustainability built in, and that the money is being spent wisely. So value for money, value-based healthcare. So that's the work we're doing, and I think the partnerships part of it, like really pooling resources together, is critical. I think like when we do a lot of this fragmented approach, and then the impact that we can achieve is not as big as we would want to. So for me, that's the most exciting thing about blended finance, in that like everybody has the great intent, but if we can pull all that together, can we achieve exponential impact with the same resources that we have?
Thanks a lot, Rishika. And these are all fantastic examples of blended finance. I think the folks who are listening to this are really getting a great perspective on all the different ways that blended finance come into play. Femke, how does a development finance institution interact with these opportunities, especially knowing, as I know as a former alumni of a development finance institution, how difficult it is for DFIs to invest in health?
Yes, thanks, John. And I think all the examples that are brought to the table are very, very, interesting. Also, Martin, the way you talked about, the stacking approach of, development finance, actually, when you said, construction mode and manage return expectations and, coordinate investments, that's exactly what we are doing at FMO. We are fortunate enough to have access to government funds, Dutch government funds, to really provide these blended finance solutions and make them work for the universal health coverage, and to promote quality care in emerging markets. And for FMO, this is important because we strongly believe that access to quality healthcare stimulates economic growth and reduces inequalities. And the reducing of inequalities is one of the major goals of FMO as a development bank. So for us, being in the health sector makes total sense. We strongly believe in partnerships, the power of partnerships. So therefore, we partner together with Amref in the Partnership for Primary Care project in Kenya, whereby we are together with Philips and Amref are setting up a company that will make sure to renovate and uplift a number of clinics in Makueni County that will provide access quality care to around 1 million of people in that particular country. We are the providers of the early stage project development capital to create, sustainable business models and to create those sustainable business models and make sure that the impact is really there on the ground. So we are not too afraid to make our hands dirty. Actually, the people in our team are co-developing and we are co-financing, looking at what kind of business model would fit best. And together with Amref, we developed, a joint theory of change. We signed a 3-year partnership. So the partnership for primary care is one project, but actually we are entering into a closer way of cooperating to looking at developing those business model in the healthcare sector in Africa. So this will not be the last one. And happy to announce as well that as of today, you've probably seen it maybe on LinkedIn, is that we also signed a partnership with Philips to also jointly with Philips create these projects in mainly in Africa. As a last example, I would say is that also when we saw that COVID was actually developing, we quickly stepped up our approach and made sure that we had funding available for specific COVID-19 response projects in Africa. And we were, before we started this session, I was briefly also touching base with Maxwell from Farm Access, because they're one of the recipients of this type of funding to really cater to COVID-19 responses. And we're happy to play that role and truly believe in doing that together. Thank you.
Thank you, Femke. I'm going to go now to the questions that have been coming in and try and, as much as possible, group them for the panelists to respond. One of the questions was specifically to J&J, but I think I'll also ask Rashika to respond as well. It's what is the J&J's overall premise on social impact investing? And I take that a little bit to be, what is the strategic rationale for a corporation like J&J to make this type of investment? I think the same thing can be asked, Rashika, of you. What's the strategic rationale to create a division whose purpose is not for profit? And I think Femke mentioned the Philips announcement today, which I think falls in line with the same thing of corporations stepping forward to make a difference on universal healthcare. Why would J&J take this step? And how does it align with the overall mission of the company, David? David, I think you're still muted.
Apologies, everyone. Yeah, I think that's a great question and very, very kind of pertinent. And I think in many ways, I think Martin touched on many of the reasons for J&J to show up in this sort of work, in terms of the work that J&J does and its ambitions as a health company. When we look at the chronic gaps in service provision for and access to health services worldwide, globally, the compelling need for additional funding to allow the achievement of these the SDGs, SDG in 3 in particular. And given our legacy as a philanthropic organization, there was clearly which I touched on earlier, this sort of sense that really there was this was need to kind of augment the way we kind of approach this sort of work. That said, the work we don't see it strictly speaking in the context of being strategically relevant or necessary to J&J, other than to say that our focus is on supporting impact investment and innovative finance models that support the provision of health. This is something that work that's kind of pioneered through the J&J Foundation, and that work is not done on the basis of commercial advantage. It very much is kind of done in the context of really supporting the kind of charitable purpose for the foundation. And we do obviously recognize that J&J does have the capacity to add value to the work that the foundation does, and we sort of see how we can enable that through employee engagement activities and other kind of programs to augment what we can do in with the various investments. I think if we look at our expectations very much in this work around impact. And that's kind of what brings us to every single conversation. And that's what kind of draws us in the first instance. There will obviously then be a kind of a financial hurdle and a financial review that we undertake when we actually engage in each of these sort of deals. But we are realistic. I mean, the ambition for our work is to serve bottom of the pyramid populations. The view really is that when you serve bottom of the pyramid populations, you have to be very realistic in terms of what level of financial achievement, financial return you can actually look to achieve. One example perhaps that I might kind of touch on in our work to date has been our investment in a $50 million WASH fund that provides low-cost loans within Southeast Asia. And that's a blended finance model using the tiered capital structure, very similar to the kind of outline that Martin presented at the top of the session, where that includes a first loss guarantee and some soft debt. But it's targeted to reach 4.5 million people over 7 years. So what we sort of see through opportunities with blended finance really is the significant scale that programs such as that can actually deliver on. And the impact is sort of clear from an initiative such as that. That said, that is a very ambitious target. We recognize that, and it's critical to structure it in such a way so that the ability to maintain the low cost of capital to the end borrowers, and that's achieved through the stacked kind of finance approach, and that in turn can only be achieved through that finance model. So in that context, I think our expectations really are layered in that, and I think are very realistic in the context of our ambition, primarily to sort of deliver impact. And with financial returns really as sort of secondary in terms of how we look at these things.
Thanks, David. And Rishika?
So that's a great question. Why do this? So I would say Medtronic, we've been a very mission-focused company since the inception, and our founder wrote a very comprehensive mission statement about 60 years ago, which, in a day of when everybody, World Economic Forum, Business Roundtable, everybody's talking about what is the role of corporations in the world and how do we think about stakeholder capitalism. I think doing this kind of work has been integral to how we think about the purpose of what we do at Medtronic, in that like alleviating pain, restoring health, extending life, which is part of our mission statement. That's not just for rich people around the world, but that's for everybody around the world. So it's very much aligned with the core purpose of what we do. And while there isn't a direct commercial benefit here, I think there is that sense of responsibility that this is our mission and how can we use our resources and our capabilities and our platform to solve those challenges, even if it's not direct commercial benefit. So that's why we do it. I think the best way to do it, whether that's through grants or through doing impact investing or through blended finance and looking at supporting innovation, I think that continues to evolve, and we're trying to keep up with that and stay at the leading edge of that and shape that in ways to come. But yeah, very much core to the purpose and mission of the company, I'd say.
Thanks a lot, Rishika. There are two other questions which I think Maxwell and Kanini can respond to. One specific to loans, but I think Kanini, you may also want to speak to it from the point of view of some of the other businesses you've invested in, which is how do these businesses at the bottom of the pyramid are able to pay back their loans, given how thin the margins are that they operate on. And then the second question is about human resources. And Maxwell, we've talked about the challenge of human resources in Africa before, but I imagine that's particularly challenging for SMEs. And certainly I imagine it particularly challenging for the types of early stage businesses that Kanini, your organization, supports. How do you manage those human resource challenges? So when we start with Maxwell and then go to Kanini.
John, thank you. I think that's where I think it's a very good question and very relevant to the players who are hands-on in the field, working in the clinics and hospitals. I can really reflect the feelings that go into such questions. I think that Martin made a very good point about the work that the coalition has been doing with the Medical Credit Fund to provide guarantees and be able to open up and unlock otherwise unavailable capital that can cushion healthcare providers in these uncertain times. And I think that one of the cushions that healthcare providers can have in these times is to have patient investment capital that gives them enough grace period, very concessionary terms, with very little collateral requirements, And here, let me just quickly mention that, these things are possible because you have development finance arm or blended finance that the risk investment capital that makes it possible to support these healthcare providers in these challenging times. So I talked about the 3 shocks that are hitting almost every clinic in our health SME in Africa. The shock of low patient attendance or reducing revenue, the shock of increasing operational costs, and the shrinking access to finance from traditional sources. And that's why, to give a very critical example, the Dutch government, through its Ministry of Foreign Affairs, supporting MCF during its second round of fundraising with about 7.5 million euro development finance, which enables MCF to set up an 80 million fund, which we call it MCF2, helped us to restructure existing loans so that healthcare providers are cushioned, giving them more concessionary terms, longer grace period, and also working actively on using the power of the mobile phone. I think Anini mentioned that along the line. Just to give you an example, MCF in Kenya in 2020 alone, during the heat of this pandemic, was able to disburse about 20 million USD worth of loans to about 260 SMEs using mobile phones. And just by the power of digital technology, you can leverage this technology and avoid the hassle of unending bank requirements and impossible collateral requirements and very strict lending terms, and be able to overcome all of these through the power of the mobile phone. So I think that blended finance gives us the opportunity to interplay this jigsaw in a way that fits the health SME in Africa, either through risking private investment capital or using the power of digital technology so that we can overcome the many traditional barriers that Martin mentioned earlier on. I think it also helps to bring in very patient investment capital. Can you mention that? So blended finance is not a vehicle for a hit and run investment. It takes time to realize these goals and also for them to become sustainable. So I think the power of blended financing pulled together can help address these challenges, whether it's an HR challenge in the midst of COVID, or whether it is an operational cost challenge in the midst of COVID, or whether it is because infrastructure needs to be expanded because now we need more isolation areas within the clinic. These are practical, hands-on challenges that, targeted approach to blended financing can help address these pain points for the health SMEs.
Thanks, Maxwell. Kanini, the same to you. How do the companies you work with, the social entrepreneurs, both achieve a margin that allows them to provide some sort of return to their investors and manage these HR problems?
Yeah, I think, John, just to make it clear at the outset, I think as investors, we need to take a step back sometimes and be ready to use instruments that are innovative and that match with where the early stage company is within its growth path. And, health is just an excellent example where, as an investor, you just can't invest in the same way as you'd invest in, say, a high-tech sort of company that's going to end up being sold to a VC in 3 years. So, one thing I'm really proud of is at DRK, we've started to experiment with other instruments, right? That, may be a better fit for a health SME operating in a difficult ecosystem in Africa. One of those instruments we've used are revenue-based financing. So obviously that only works where, the early stage company does have a little bit of revenues coming in. And as we know, equity is expensive and sometimes debt is not suitable. So one path that could be used, and obviously it has to work for the entrepreneur, they've got to understand what this means in terms of their overall P&L, but you could actually tag your investment based on long-term revenues. And then as an investor, you're sort of aligned with the entrepreneur in terms of what his or her, growth targets will be in the future. So I think that's something that we're starting to see is gaining traction amongst some of our early stage African entrepreneurs, specifically in the health space. Another one that we haven't yet executed, but we're looking at are repayable grants, right? That's, people may call that debt, but it's actually not debt. It's basically a grant that is repayable, but on very concessionary terms, as opposed to straight debt. So to someone's question there around, how does an SME, pay back this expensive type of capital? This is another way to do it. And that is the advantage of having capital that is what I call soft, and that is not tagged to, overly high rates of return and overly high expectations in terms of exits. And that's something I'd really like to raise as well is, as impact investors, I think there's many types of impact investors. And I think David has mentioned it in terms of J&J's approach. There are some impact investors who just operate like mainstream investors with an impact tag. And, if there's entrepreneurs on the call now, I think you do need to be able to identify them and understand that if there are unrealistic return expectations around what's going to come back to the investor over a really short period of time, if the instrument is not aligned to your overall goals, if impact is not a focus of the investor, that's not an impact investor. It doesn't matter what they're calling themselves. So I think it's just something that we just need to be careful in our sector and in deploying capital to this particular space. And we just have to sort of call it out because that's what it is. And then I think just lastly, when we're looking at debt, obviously, we're not looking at bank debt because in Africa, we know the average interest rates are double digits and they require collateral, as Martin said. So just to clarify, when we're looking at debt, obviously it's not bank debt because that is not a sustainable way to finance an early stage health enterprise on the continent. It's really these other innovative instruments that investors can use and just make sure that they're aligned with what the enterprise needs at that particular time.
Thank you very much, Kanini. Femke and Martin, we have about 2 minutes left. Can you have some cleanup comments in a minute each, and then I'll say the final words and we'll move on. Femke first, then Martin.
Yeah, I think what Kanini also mentioned is quite important to, there needs to be a reasonable financial return also for impact investors. But please, be very critical also if you're a health entrepreneur and make sure that you really drill down what is driving, this type of money, what is driving this investor. And one final remark would be, look at the whole chain, from the start where you want to start till the end, what are your financing needs, and try to sort of make that puzzle up front. So don't, do it as you go because you might, enter into some difficulties, but use Martin's stack methodology to the extent possible, because it is not always possible, and then work your way towards your success.
Martin?
Yeah, thanks, John. Fantastic conversation. 2 quick points from me. There was the question about the role that corporates play and what motivates them. And, it's worth remembering that blended finance is not in lieu of charitable, contributions. And so all of the partners that we've mentioned and those represented are doing really good work with pure donations through their CSR initiatives. Blended finance is a way to build on that at a different life cycle in these projects. We've heard from David and Rashika that they're investing in demonstrating models. Blended finance comes in when you want to scale those models. And so if you want to take, Rashika mentioned working in 3 counties in Kenya. If you want to get to all 47 counties in Kenya, the donor dollars aren't going to get you there. And so that's where blended finance can help to scale these initiatives.
I want to thank everyone for a great panel. Again, thanks Danny and Amref for sponsoring this. And I just want to finish on 3 themes I heard that are pretty critical to going forward. One is partnerships. that we can't do this alone. We need to figure out how to work together to make this happen. Too, as Kanini was saying, we need to be creative. We need to think about new instruments that can get us where we want to go. And three, we need to connect to the overall, what you just mentioned, Martin, about scale. We need to connect to the overall goal of nationwide, continent-wide impact and break out of our sort of little pilots and find a way to make those at a level that really is going to move the needle on UHC. So thank you all for attending. Thanks to our all-star panel. And Danny, I don't know, is there any last comments, instructions you need to give?
Yeah, well, a big thank you to everyone. An hour is not that long, and it does not feel like the end of a discussion, but more as a beginning. So I definitely hope that we can continue conversation around this exciting topic. But for now, well, thank you, John, Martin, Femke, David, Rachika, Maxwell, and Kanini for your wonderful contributions. And I'm looking forward to continuing this conversation.
Thanks, everyone.
Thanks very much.
Bye-bye.
Thank you.
Thank you.
Bye-bye.
Bye.
Thank you. Bye.